Okay. So FOMC, 4 more minutes from now, we have the interest rate, and then we have a Powell press conference at 2:30. Let me just make sure the stream is running good. Okay, I think the stream is good. Um, all right, let me just post this. All right. Let's just make sure we're all good. Can everybody hear me, see me? Could everybody hear me and see me? Yes or no? Okay, sounds good. Okay, so first things first, I took one trade earlier. It was a smaller position short. We nailed the highs, but it was just a miss execution on my end. So I'm down about 750 on the day. Really small loss. It sucks being correct on the analysis, but it's what I get for trading pre FOMC. Not the biggest deal. We're going to be looking for another opportunity. Zooming out, going to a 30-minute chart, what we're going to see here is the market's at highs. So we are discovering new prices, right? When the market's discovering new prices, it's not our job to discover them for the market. So right now we see a very large rally and the market is not at resistance. There's no supply. There's no demand up here. We're just hanging out at this level. Now, 2 o'clock's going to roll around, most likely going to see a very large, unpredictable, sporadic move. And then directly after 2 o'clock, we have Powell speaking at 2:30. Usually a continuation or a reversal of the first initial move occurs once Powell opens up his mouth. I don't follow I don't follow fundamentals. I'm not so concerned of what gets said. I'm more concerned about what I'm seeing in front of my face. And that's what I hope to do in this live stream so you could all see what I'm seeing and understand my analysis. I can't sit here and say I have a plan for this. Trading this FOMC is a gamble. It could go up, it could go down. It's 50-50. But there will be new information that gets developed after this news. And maybe we could take a setup or maybe I find something that I like. And we'll go from there. But right now the market's just hanging out at the highs. The profile is just collecting volume at this high. We have we have no volume traded. Let me pull this up here one sec. We have no volume that was traded around 45.15 all the way down to 43.95. These levels tend to get tested. So you see here in the profile, there's 0 volumes transacted there. Most of the time, the market likes to revisit these levels at some point in the near future. I'm not saying it's going to happen now. But at some point, the market likes to test those levels to make the auction fair, for prices to get tested. And here we're seeing the sell-off into this right now. So remember, if you want to trade this, be my guest. I'm not going to tell anybody how to trade or what they should trade. But trading this is a gamble. Trading this is unpredictable. There's not a great edge. And I've seen a lot of traders blow up accounts by YOLOing or just entering or exiting based off of they see the market coming down or up. So be patient. New structure will develop. And information will be presented to us that we could use to our advantage. So here's the first initial move. So here's the last time we had this same data getting released. Was May 1st, April 30th. So I'm going to go back and show you all what happened there, just so you could get a better understanding. If this is your first Powell press conference, which I'm sure a lot of you it's probably not, but I just want to show you the type of moves that you could see. Here off the initial reaction, we see a quick pop, followed by a Powell's press conference at 2:30 with a very strong rally. Directly after that, the market immediately dips and loses all of the gains from the last press conference. This was on May 1st, 2024. So most likely going to see a bigger move than this. This is nothing in the scheme of things. We have 30 more minutes until Powell's press conference. There is some volume here at the 17s. My DOM resets at the open, so I don't have it. But before the market was open, let me see if I could pull this up here. At 54.17, we can see, looking at the profile, we could see a large print here for negative 1,500 lots at 54.17, which the market came close to, minus 15.08. So that means 1,500 contracts hit the bid as the market was moving up aggressively off of the CPI news at 8:30 today. So this is nothing in the scheme of things. There will most likely be a much larger move than this. Just be patient and don't force something. You could kind of throw technicals out the window with this, in the sense of what people will do is they'll see a larger lower wick. And again, like if you want to trade it, I'm not telling anybody how to trade, but how I view the market is what I'm going to explain here. Technicals for me kind of get thrown out the window with this decision and with the press conference because of, let's just say you see a lower wick, right? People are going to look at this right now and say, hey, there's a lower wick present in the market. And just because they see a lower wick, they, number one, don't put emphasis on the conditions, don't put emphasis on the news. And just because of technicals, they see a surge of volume and the lower wick, and they say, okay, automatically this thing must be bullish. Not realizing that in 20 minutes from now, we're going to have Powell speaking, and not realizing that the sporadic, unpredictable, volatile price fluctuations can completely destroy your position if you mistime that move. So just be patient. I want to stress patience a lot. Because a lot of people force things, and it's very easy to when you see the market move in this volatile approach, right? They see red on their screen, they see green on their screen, and they think that they're going to miss a move. Don't think like that. In fact, don't think at all. What do you guys want to see? Do you guys want to see the DOM? Do you guys want to see a full screen of a chart? You guys want to see the heat map? Let me know what you guys want to see on my screens. This is just my main screen that I look at. So, I mean, if you want to see something else, just let me know. I could pull up the heat map for those that don't have access to the heat map. I can get rid of the DOM. I could get rid of the chart. Whatever you guys want to see. I don't know what it is that you guys want to see. But this is my main screen, what's directly in front of me. So you see nothing but chop right now, and that's expected. It's currently expected. NASDAQ, same thing that's happening with the NASDAQ right now. NASDAQ, I don't have any levels at the current moment other than it's bouncing off of VWAP. The reason for this, all-time highs, which is pretty crazy. We're close to 20K, which is actually pretty nuts to even say. A lot of people want to see Bookmap. Everybody wants to see the heat map. Somebody asked, am I on a 2-minute or 5-minute? So I'm constantly switching between time frames. Like I'll go to a 1-minute, 5-minute. I rarely use any candlestick chart to tell me when to enter or when to exit. Like I'm not looking at a 5-minute candlestick to close to say, hey, you should sell here or you should buy here. I'm reading the orders on my screens and I'm gauging what the volume's like at my levels of interest. But right now we're not at a level of interest. And in 20 minutes, most likely once Powell begins to open up his mouth, we're going to see a sporadic move. But yeah, no, I use my entries. Like I'll base all my entries off of this heat map. Like if I see something right here, right, let's just say we're at a level of demand and I see a lot of selling coming in right now. I'm not going to my candlestick chart and going to a 1-minute and waiting for this thing to turn green. I'm looking right at, call it my heat map, but I also use like the DOM and stuff. I'm entering as soon as I see, hypothetically speaking, buying volumes coming in and sellers are trapped. I'm getting in right there. I'm not waiting for like the 5-minute to get above VWAP. I'm not waiting for a moving average to cross. As soon as I see volume confirm my thesis, I'm getting in. And that's how I get good entries. Like last month, I had a 40% win rate. And I attribute a lot of the success to my risk to reward ratios because there's some trades that I'll get a 7, 8, 9 to 1 risk to reward ratio because I'm narrowing my entries down with the tape. So I rather sacrifice lower win rate and I'd rather take the hit and be wrong 60% of the time, 70% of the time. I'm okay with that because I know when I'm correct, a 7 to 1, 9 to 1 risk to reward ratio, I can be wrong 70% of the time and still come out green. So I don't know. Somebody's saying you learned using the DOM from me and basically you barely look at candles anymore and your trading has massively improved. Thank you so much. I appreciate that, Andre. I really don't know, besides my cousin and my uncle, I don't know anybody on the Wall Street setting that is a short-term scalper that relies on time frame candle charts to buy or sell. Specifically trading futures, not so much options. But everybody that I know that scalps, and it's a handful of people, do not use a candlestick chart and they use tools like a ladder, depth of market, footprints, matrix. So that just validates and goes to show you a lot, you know? Do I primarily trade the ES? Yeah, the S&P is what I make the most amount of money from. A lot of people want me to like trade NASDAQ and stuff, and I'm willing to do so. It's just that when you have something that works for you, I have a philosophy of just not fixing something if it's not broken. And, I enter the market with confidence because I watch the ES tape and I watch the ES volume for many years now that it's almost become like second nature in the sense of I know exactly what I should be avoiding and I know exactly what I should be focusing more on, and other instruments that I don't have this 8 years of experience in, but S&P is more like 6 years. I don't have 6 years of experience in, let's just say, oil. So I'm not super confident in judging my tape reading abilities on other instruments that I haven't had X amount of hours in like I have with the S&P. I know I would trade the NASDAQ really well, but again, I don't have anything that's broken, so I don't want to fix it and I don't want to change. But maybe looking back, I could be saying, hey, what I'm doing right now, as well as I'm doing it, could be broken. And if I get into other names like NASDAQ and oil and gold, maybe what I'm doing right now, looking back, would be broken. And what I could be doing has tenfold the results. So it's all about it's all about perspective. Everything comes down to perspective. I mean, ever since I started this stream, the market's basically been trading at the same prices. We're middle of the range intraday, right? So this is something you want to gauge on a daily basis. And this is something that I look out for constantly, is where is the market in relation to the intraday range, meaning where the market has opened at 9:30 Eastern to where we are currently trading. And this is applicable to any market, any stock, Forex, crypto, Tesla, Apple, Nvidia, NASDAQ, oil, gold, S&P. I'm always looking at where the auction currently is in relation to where we opened and in relation to the current range. What I mean by that is right now the market is currently inside of the intraday range. If I were to remove extended hours and you could just see the current day's range, right? We're in the middle essentially of this range. If you are a reversal trader, even a breakout continuation trader, the edge should never come from the middle of the range where we're currently trading at, right? Majority of reversals come from the edges or the extremes, and majority of breakout continuations come from the edges or the extremes. So I'm always observing where the auction is in relation to where we opened and in relation to where the context is since we have opened, and the market's been open for what, 4+ hours now, and right now we're in the middle of the range. So number one, that's a red flag. Number two is I'm looking at the overnight range. I'm looking at the overnight, which we're well below the close, and we're essentially right at the open. So we're basically coming down now back into the overnight range. And the next thing that I look at is, other than conditions and understanding that we have news coming out in 15 minutes, or not really news, but Powell opening up his mouth, is the volume and volatility. Right now, the volume is high, but the volatility is low other than the 2 o'clock news drop. I like trading when the volume is high and the volatility is high, because when I see volume and volatility, that usually means the momentum is there. And as a short-term trader, momentum is everything. For example, the trade that I took earlier, which was a 1-point loss, I took the market short at this high right over here, right around here, right? At this moment, the volume was high and the volatility was high. That's not to say the volatility can't increase after executing. So this was a great short trade that I took earlier, just simply mismanaged. We eventually, are down from that, and this would have hit my target and paid out nicely. But comparing this range right here to, let's just say, this range right here, we could see a night and day difference. Number one, the volume has dropped. And number two, the volatility, which we see over here, I'm going to label this as a blue circle. Here you could see a little thicker type of candles. You could see the volume is higher. You could see the momentum. You could see the range also was increasing compared to the right yellow oval. Something like this, if I'm scalping, is not something that I'm inclined to do, because I know when I'm scalping, I want the quick moves. I don't want to be sitting in the trade for 3 hours when the volatility and volume are dead, right? So now, right now, other than this 2 o'clock drop, we are sitting sideways as participants are waiting for Powell to open up his mouth. Hosts a live stream from trading and only gives excuses of why he doesn't trade FOMC. I don't know if you recall, but there was another FOMC that we live traded and took a nice, I want to say 15 or 20 point long entry off of that. So right now I'm warning everybody to not trade this chop, not giving an excuse not to trade. I'd rather see people play defense than play offense. I'd rather people swing for base hits than go for a home run and strike out. Um, and here's another thing too is that like people think you got to trade every single day. Like once you have a strategy, and I could think of two people off the top of my head that a lot of you probably follow. Out of those two people, they have a strategy that's works for them. And if you look at all the trades they take, it's based off of their strategy. Like they're not buying and selling by guessing. They're not getting in and out by expecting they expect the market to go up or down. They're getting in because they've located the opportunity and they've located their setups. So right now there's no setup that I'm locating. And if I were to trade this, it would be me forcing an opportunity. But that's not to say that in 20 minutes from now there could be a high quality setup. The market will pay those who are patient. People are asking, what's this on the left? This is a custom Sierra charts depth of market. The right is a Thinkorswim chart. I do not execute off of Thinkorswim. I just use it for charts. Yeah, the real move is Powell's speech. Absolutely. Yep. So now we're moving back into the range. So here's how I plan on trading this if whatever occurs. If it moves up or down, this is how I plan on trading it. Ready? I don't like taking the initial reaction. And this is really the only way that I'm going to be comfortable taking a trade off of this news is this right here. So let's just hypothetically speak and say the market rallies up and we see a nice green candle, right? Well, for the market to move up in this approach, most likely there's going to be signs of strong buying that we could spot on the tape. So now what I would do is I would see the move up or even call it move down, right? Let's act like this is a red candle. And let's say this moves down or up. I don't care which direction it goes. In this process, what's going to cause the market to move up or down is volume. So in this period, there will be activity, whether it goes up or down, that's going to leave trails of either buyers or trails of either sellers. So what I like doing, especially taking news type of trades, is I like letting the initial reaction occur, up or down. And let's just say it moves down, let's call it. What I would like doing then is if this oval is selling pressure, make this red, I would let the market first initial come down. Then I would get in, let's just call it on a rally up or a retest of those sellers that were present on the drop. Because on the retest, number one, that's going to validate sellers are present. Number two, that's going to validate that sellers have an agenda to move the market down because they are defending price. And number three, that's going to offer proper risk to reward because I would be getting in on, let's just say, the retracement up. Shorting the lows or selling the lows could work, nothing against that. But if you are buying after an extended move, your risk to reward becomes skewed. A lot of people ask, how do I get good risk to reward ratios? And it's because I'm most of the time getting in on a reversal or a retest of the sense of we're getting a pop up and it's offering an opportunity for sellers to reload. On this move up, now I can get short, hypothetically speaking, put my stop loss above the high that it forms here, going for a breakdown. versus getting short down here. I would have to place my stop loss where I'm wrong on the analysis, and let's just say it would be where the drop initiated at. So it all comes down to risk to reward. And every single trade that I take, I factor in my R multiple before I enter that setup. And I put myself in the position that even if it might be not the best conditions or maybe not the best confirmations, if I'm risking, let's just say a point or 2 points, and I want to jump the gun early and get in with not the best confirmations, I'm okay with putting risk on because I've accepted it before entering, and because my risk is super small, that I could take a 1-2 point loss paper cut that I know when I do time it correctly, it might be a 10, 15, 20 point, reward in my favor. Yeah, listen, I've seen people blow up accounts. I've seen people force setups. If you want to do it, be my guest, but understand the risks to it. I'll never tell anybody what to do because you'll find success doing your own thing. At the end of the day, I can really only speak on how I view the market and how I trade and, my approach to it. I never want to deter anybody from taking a setup that's right in front of their face that's based off of their strategy. Do I factor RSI into trading? I don't. I used to. It's more noise for me. If I were to use any indicator, it probably would be RSI instead of a moving average. 5-minute demand. Yeah. 5-minute demand is there. The issue is that I really don't use 5-minute zones. It's also a very small basing, and also there really wasn't much volume that got transacted here because that was done off the 8:30 CPI news. What do I use for execution? I use AMP futures. It's connected to Sierra charts, which is on this depth of market here to the left. Why not execute on Thinkorswim? Thinkorswim has high margins, and commissions also are a little higher than normal, but the margins are a little high. Um, I don't know. I don't like TOS for execution, at least for futures. Options is fine. Uh, any trades today? Yes, I took a short earlier. Was a great entry at these highs up here. We got the sell off. It's just there was some buying activity on the afternoon session and the volatility died out, so I protected myself. I would have never stopped out, but it's a 15-point loss, about a $750 red on the session so far. Thoughts on GME? GME, there's really no technicals to this. It's a complete hype and gamble. You can easily make money off of it, but you could easily lose it. Here's the thing, and I've talked about this numerous times, and you could see this in my trades, you could see this in my reviews. For those who are an invested trade, you could see this in all my trades. Every single trade that I take, win or loss on it, has similar characteristics, that I'm trading the same exact setups. And if I take a losing trade, I'm not switching my setup because I lost on it. Every single win, every single loss is based off of the same setups because those are the setups that make me money. So it's all about finding repeatability in your trading. And a lot of people, if you want to trade GameStop, if you want to trade a random rally off of this FOMC, do it. Be my guest. Whether you win or lose on it, it might serve the greatest lesson for you in your trading that will outweigh every loss in the past for lessons that you may learn in the future. But for me, I like trading setups that are repeatable. I'm not the biggest fan of trading something that, yeah, I might be able to gamble on right now, because that's just going to instill bad habits. Like, deviating away from my strategy could make you money, and that could feel good that one time you make money off of it. But number one, it's going to instill bad habits. And number two, if you do deviate away from that, now you're going to lose sight of the whole repeatability aspect of your trading. Every single trade that I take is based off of a repeatable, methodical approach. And I think it's very vital for every trader to have that the setups they take are repeatable, because you're only going to repeat things that work for you. It may not work for you one time, two times, three times. You may take losing trades. It's going to happen. But in the long run, that methodical approach has to be repeatable, because once it's repeatable, you've figured out something that's going to extract profits for you in the long run in the market. It's all about repeatability. Think about that the next time you trade. Just always think about that. Let me remove this before people think this is a zone. There's really no levels that I have here. I mean, the 15 to 10s is something that I would be watching based off of the volume overnight. But we got 3 minutes till Powell starts opening up his mouth. Do I go full size on the initial position? So this is the last thing I want to talk about before the announcement. First of all, actually, do you guys want to see the depth of market? Do you want to see a candle chart with the heat map? Let me see if I could run a poll. Let me see if I could run a poll. I'm going to run a poll on YouTube chat. Would you want to see candle chart and heat map, which is book map, or candle chart and DOM? I just ran a poll on YouTube. Click that poll and let me know. You want to see the candlestick chart and the heat map, or candlestick chart and the DOM? Whatever wins, I'll put on my screens. We got about 70% said candlestick chart and heat map. All right. This over here. I'll actually move this. All right, about another minute until Powell's press conference. If you guys want, we could also watch Powell as well. Got nothing on the footprint. Right now, we're in the middle of the range. Again, I highlighted what I'm watching and how I'm watching it. I'd rather miss the initial move. Let the market move up or down. It can move without me. But on that trail of up or down, it should leave footprints of buying or selling. In that example, I would rather wait for a retracement back into that buying or selling volume, where then I could open up a position. But taking the initial move up or down is not something that I'm interested in, and I'll just say that right off the bat right now. It's a complete gamble. Tell you what, it would be crazy to see a massive rally up. See 5,500 plus would be insane, and 20K on the Nasdaq. That would be insane. Desi Trades in here. Everybody go show some love to Vince.
Briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect it to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation over the past 2 years, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Here come the questions. This is when it's going to get good.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So
remember, if the market makes an initial move, I will not be taking that initial move. I will be taking the retest of that move. The initial move will provide information that we don't have, and we can use that information to our advantage at some point in the future intraday. So initial move is not something that I'm interested in. There's no edge in that.
In the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and then hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising
Here we go.
core PCE.
Here we go.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher, 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Timmeros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances of the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
Question for everybody. Does anybody see a setup? Does anybody see a setup trading this? I'm just curious to know if people trade like the news and gamble with it, or am I the only one that doesn't see something right now? I'm just curious.
What I hear and see is that people are looking at
Like, does somebody actually see a
outcomes. In
setup
many cases,
that they're trading right now?
They're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we asked them to write down the most likely one, so they do. And as I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible. But I look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what
He stuttered a little bit.
It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many, because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first
Here we
day,
go.
second day, what we do is we make sure people remember that they have the ability to
Market's
update.
moving much
We tell them how
faster
to do
now.
that.
Still in the range,
And
but
some people do, some people don't. Most people don't. But and I'm not going to get into the specifics, but you have the ability to do that, so that what's in the SEP actually does reflect the data that we got today, to the extent you can reflect it in one day.
yeah, I haven't seen a
think
chop like this in a little
we'll
while.
see PPI
Probably like the
tomorrow.
past
We'll know more about
2
the
FOMCs.
PCE reading as the month goes on, but the initial CPI reading and its kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, you know, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually.
Yeah, I don't see nothing at the
all
moment.
that together, what you have is still low unemployment, still 4% unemployment, historically low.
From the minute that I got on the live stream to where we're at now, the market basically is trading at the same prices. We're moving back and forth, and Powell's taking questions now, and the market really still has not moved, despite the decision and Powell's press conference.
So that's what we see.
And remember what I said earlier, we're still inside of the range. We're still lacking volatility inside of the range, not at a level of interest.
Carefully for
if you see a setup, you take it.
See that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, you know, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, I mean, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market.
Market's not going to like that
Job
one.
openings, while they've come way down, are still, you know,
It's not gonna
greater
like
than
that.
the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is.
I would
still
say
a
it's
very
likely,
strong
I know
labor
we're
market,
only
but not
15
the
points away,
superheated labor market of 2
that
years
some
ago,
prices
even
of the
1 year ago.
CPI rally under 40 or under 54.15 to 5400 probably will get tested.
The SEP
Maybe not today, but at least by end of the week.
I
I mean, we're so close, so I would expect it to be
That's a period in
today.
which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitude?
Yeah, like I said earlier, there's the volume here. There's 0 transactions at 54.15 unless my data just did not upload. 54.15 to 53.97, there's essentially 0 volume or 0 transactions there. The market usually tests those levels at some point, whether it be intraday or the near future. If you could see here on the heat map, there's 0 volume transacted here on the profile at 54, call it 17 to 53.95. Maybe it's not today, but at some point this week, more than likely this level will be tested again because the market needs to test the levels where there was 0 transactions that have occurred there. Let's go back to Powell.
So if you look at year-end 2025.
Yeah, this is the
26,
choppiest
it's
one that I've
almost
seen in a
exactly where it
while.
would have been,
The
just
past
a
2
few
sessions,
later
FOMC
because
were
of
pretty
that
good.
Yeah, you get different data today. So we'll have to see where the data light the way. You know, we're at the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long run neutral rate of interest is a long run concept. It really is a theoretical concept, can't be directly observed. And
Yeah, the market probably will move once he gets off the podium. For it to not move for about an hour right now,
in the future where
probably
there are no
will wait
shocks.
until after the podium.
It's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R star, it's a very important concept in economics and in what we do, but honestly it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But I back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have, and I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Stein with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had, above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and you will see what the rest of this year brings. So these dynamics can continue as long as they continue. I mean, ultimately, the question is are you down to demand? And we don't know that though. I mean, we're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress.
Yeah, I'd like to see what happens above this 54.45 high right here at the 230 mark. I'd like to see what happens above that. There was some activity earlier in the session, which is why I took that trade short earlier in the day. If you're an investor trade, let me see if I could pull it up here. That was around 10:30ish. There was some significant size here at 54.50, call it. So let's see, maybe I don't know, a scenario that I'm possibly watching that I could think of off the top of my head would be
point for a rate cut.
would
Well,
be
we
above the
think policy is
45s,
restrictive.
but not above the
And we
50,
think
51s
that
to reject.
if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates,
Yeah, they were
this low,
selling around
we've
like
always been
1040-ish,
pointing to cuts.
1035.
Not to eliminate the possibility of hikes.
If we
but,
break the
no one has
45s,
that
but not above the 50s,
So,
51s, it
no
could
one on the
spark
committee
my
does.
interest, possibly.
So that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress.
But this is
on
a pretty
inflation
muted
with growth at a good level.
Fed talk.
And with a strong labor market now.
Very muted,
Ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So we're getting.
Somebody asked, why do I use Rhythmic versus DX feed? I don't know. The data will be very, very similar. I don't have a problem with Rhythmic. I know a lot of people have been having problems with Rhythmic, but I believe that had to do with prop firms.
Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize.
Yeah, I think it's a good idea to watch the
national
VIX.
housing shortage, as there was before the pandemic. There will still be one, but the distortion.
It's a good idea to watch the VIX. The VIX should leave signs of the deeper picture of the market. VIX is very muted right now. But if the market does start moving, it would be important to watch the VIX.
Banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
So I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places, in some parts of.
What platform am I showing? The left is Thinkorswim candle charts. The right is a book map. Book map shows me the heat map. It also shows me a profile of the volume. I also use other platforms like Sierra for a footprint and for a depth of market. This is my depth of market right here. This essentially shows me very similar information like the heat map shows me. Do I prefer cutting my losing trades right at my stop loss or only when my thesis is wrong? Well, my thesis will be wrong where my stop loss will be wrong. My stop loss will be placed where my thesis is incorrect. So I'm always exiting where I'm wrong, and that's my stop loss. Yeah, I don't know. I don't. Powell really is not.
Inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
I don't know. I'm not liking Powell today. You want to see the footprint? Columns on Bookmap. The columns on Bookmap are RTH is just basically a profile of the cash session from 9:30 market open to now. That's RTH. It's just a session volume profile of that. CVP is what's on my screen. If I zoom in, you'll see the data changing at the CVP because that basically is just showing me what's on my chart. And SVP is an overnight and intraday profile. So this shows me overnight data. I like seeing the 3 different pictures. NASDAQ is right at all-time highs. Yup. NASDAQ's at all-time highs. Apple's at the highs. Apple's up 6% today. VIX is now breaking the high of day or testing the high of day. It's a little dead to me, but will be interesting to see if VIX breaks the high and the S&P has not broken the high. This is getting a little soft to me. So here's the thing. Like earlier I was saying, I want to short those 45s, but not above the 50s. Hypothetically speaking here, have not taken a trade off of that. If I were to short, let's just say the 40s, 41s, I would have to place my stop loss above the 47s. That would be about 6-point risk, which is good risk, right? But what a lot of people have to do is they have to tweak their position size to fit their risk. Hold on, I just want to see what... So if you're risking more points, which is fine, adjust your position size. So let's say my normal size is 30 full-size contracts, and my normal risk is 2 or 3 points. If now I'm risking 6 or 7 points, what I would do is I would cut my position size in half, because if I'm wrong on that setup, my loss would equate to what my full-size position normally is. So yes, we've rejected that level, but if I'm short here at the 40s, my stop loss is a little too high for comfort, especially being in the middle of the range. How to read bookmap. I have a lot of videos on my YouTube for this. It's not learning how to read bookmap. It's learning how to read the tape. Bookmap essentially is a tool which shows you the tape. So I wouldn't jump in learning how to read bookmap. I would jump in and learn how to read the tape. Because once you understand the concepts of the tape, being able to look at this heat map, you'd be able to, see it a lot clearer. Oh yeah, my VIX is inverse, so that's why high a day. VIX normally is at low of day. I look at an inverse VIX. So when my VIX is going up, the normal VIX is going down. Yeah, good call. Do I go full size on my initial position? I do, yes. I rarely, probably 99.5% of the time, I go in with full size, and the 0.5 will I add, 0.05. I rarely ever add. I don't know, this is just a muted reaction. I don't really have confidence at these prices. Middle of the range, FOMC and Powell, the market has not moved anywhere. The VIX is inversely breaking the high of day and regularly breaking the low of day. So that's an interesting observation here while the S&P has not taken out the high of day. We took one trade earlier, which was short at the highs, and that's all I've taken so far today. Yeah, one of those days where the market makes a move close to the close. Yeah. When to walk away? You walk away when you don't see your setup. Set an alert and come back if you see a setup when your alert triggers. NASDAQ is right at the all-time highs. Right at the high of day. VIX has broken below the low of day. S&P is a little muted, lagging behind. So let's see how this develops here. Yeah, market's gonna rip when he's done talking. I would
remain are going.
I would agree with that. Or
levels,
market will
and they still
move
are.
when he's done talking.
This is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries you should just ignore that, but that's not our.
Yeah, I don't know. I would not, and I am definitely not interested in longing under the 51s. Um, Under this is a no long level on a move up for me. Under the 50s, 51s. This move up, until it gets above that, I would not be long in this under that. Keep in mind, middle of the range, volatility is dead. Wait for things to pick up. Thank you for the videos. They have helped me a ton. Keep posting. Appreciate that. Appreciate that. Yeah, it seems like a lot of good moves have been happening overnight, which kind of sucks. It's good for those who trade the overnight session. At least levels off of at least moves off of levels have been happening overnight, like predetermined levels. Nasdaq broke above the high. It's somebody saying is a false breakout. It could potentially be a false break. Absolutely. Again, I would not be long in the S&P still below the 50s. In fact, I would be mainly looking for shorts. The problem is that I do want to take a short position here, according to my plan above the 45s. The issue is that it's been an hour and the market has not moved up and the market has not sold off. If I were to go back to majority of my losing trades, it's when I'm in the position expecting it to move up or down after a period of chop. So after a period of chop, what I rather like letting the market do is I'd rather let it move and then I could get in on the form of a retest. If you've shorted the highs, let's just call it, right? I go to a 1 minute chart and you've gotten great entries every single time off of the high here, right? The high here, according to the plan above the 45s, even this high right here, right? Yes, the market has sold off, but we've lacked the continuation down. So even if the confirmation looks great right here, we are lacking the continuation down. I've taken many setups, even a setup that I took earlier this week. And if you're in an investor trade, you know exactly what I'm talking about, where I was taking a setup after a period of chop, expecting the market to move, and it never moved. So let the market move. Let it digest. Let it do its thing. Don't try to be a hero and expect or anticipate it to move when it's not moving, right? Let it do its thing. Don't try to figure the market out for itself. Let the market figure it out, and then we can figure out our own trades after the market figures its shit out. It's crazy how much waiting is involved in trading. Yeah, because you have to wait for your setups. I've talked about this in a different somewhere before, where it's in trading, it's locating your setups. It's locating opportunity. We're not trying to create opportunity. For me to get in short right now, let's just say, or long right now, I would be trying to create opportunity, because when I'm creating opportunity, I'm trying to create a false assumption about the market based off of where I'm expecting it to head. When you locate opportunity and you locate your setups, you're identifying an edge that you have previously seen work in the past, and you're finding that at a high probable location. So start locating your setups and stop creating setups in the middle of the day. Do I see anybody who's trapped? No, you know why? Because when the market is in the middle of a range like this, no one is going to be trapped. Think about this. From an auction perspective, if the market is sitting sideways and we're balanced, that means buyers and sellers are basically equal or fighting it out. And one side does not have an advantage. The best trades, especially reversals, come from once one side has an advantage. When we're in an equilibrium or a state of balance or a state of basing, there's not one side that is winning that battle. The best trades will come from when one side is outweighing the other. Right now, not one side is winning, so nobody will be trapped. Once people are trapped, that's when the reversals happen. Once the buying is more aggressive than the passive selling, that's when the market will move up. That's when you'll get the breakouts. Once the selling is more aggressive than the passive buying, that's when you'll get the breakouts down. So right now, we're just sitting sideways. We're coming right back into these 49s, and this is the same exact level that we saw earlier here around 1035, 1040. So as long as the market remains below this, I would not be buying this move up. Until it gets above, then it's a different story. But below this, I would not be buying it. There's some significant activity here at the 45s and 50s. If I were to just zoom out, let's go over here. You know, until we get above this, I would be cautious for longs if you're not already in long. Some significant size here. I'm going to mark this. Yeah, some significant size here. Yeah, it's going to be one of those scenarios where we're going to see a move probably very close to the closing bell. Yeah, Powell is still talking. About to see a new high a day here on ES, and NASDAQ is at highs. Super glad you haven't taken anything yet. Thank you for keeping me patient. Awesome, Ben. Let's see if this level could act as support. If this could act as support, I wouldn't mind taking it long, going for a high a day breakout. We're very close to high a day. New high. And this is a high of day rejection. This is an example of you look your head above it and it fails. Right? Did anybody see that print? Let me see if I could get this up here. Did anybody see that print at the high of day? In a matter of 2 seconds, it bleeped above the high and immediately got rejected. That's a sign of weakness in an auction. Now you can see the volume has started to come in. Powell's done talking. Now the real move could occur here. Yeah, that's a great example of a look your head above and fail type of scenario. Yep, moves coming when Powell stops talking. Was talking for an hour. And as soon as he gets off the podium, that's what happens. Right, so keep this in mind. If you want to short this right now, do it. Be my guest. But if you're short here at the 36s, where are you placing your stop loss? If I get short at 36, where am I incorrect on my analysis? For me to be incorrect on this, my stop loss would have to be near the high of day, which is about 20 points away. It would not make sense, even if this thing comes down, to short this due to a poor risk to reward. If I'm short here at these 32s, where am I placing my stop loss? I'm always thinking about where I'm wrong before I'm entering that trade. It could keep selling off. It could move without me. But if I'm short here at the 32s, where am I incorrect on this? Yeah, exactly. Before you get in, you have to know where you're getting out. Absolutely. Before you get in, you have to know exactly where you're getting out if you're wrong. from high of day to low of day in 10 minutes. It took 6 hours for the market to move in that range and 10 minutes to trade that range. Again. Look at all that selling volume. There's a lot of trades hitting the bid. Some massive size here. So here's those 17s that I was talking about earlier where there was 0 volumes transacted there. We can see the negative delta of minus 1500. 1498 there. We're right at it. That's that level that I was explaining earlier. Remember, trade when you see your setups. Trade when you see your setups. I trade when I see my setups. You trade when you see your setups. Hitting the bid means you hit the bid. Level 2, bid versus ask, bid versus offer. Hitting the bid is an aggressive sell. The aggressive seller is selling to a passive buyer. Yeah, SPX SPY puts definitely paid. I mean, this is when options strive, is when you see these volatile quick moves. Absolutely. But they paid on this drop. They didn't pay earlier in the day. When you get the volatile moves fast, that's when they pay. Yeah, I would love to see a breakdown under the 17s. I would love to see that. Do I filter my time in sales? Um, I don't really use a time in sales as much. If I do, yes, I would do about 40 to 75 depending on the volume on ES, and about 10 on NQ. Tutorial on Sierra charts, yes. Am I looking for a short now? No. Imagine longing a high of day and then shorting the low of day. I don't like opening up a breakout on one of the most liquid markets at all-time highs, or shorting a breakdown at all-time highs. It's one of the most liquid markets, so most of the time it reverts back to the mean, which is why reversals, in my opinion, are the better setups on the S&P, is because the market 70% of the time, 80% of the time balances out. Do a tutorial on how you spot big buyers coming in on footprint chart in Sierra charts. Um, there's tons of tutorials in InvestiTrade on that. Daily Beats. Yeah, again, like this is why I do not favor longing a breakout above a high or shorting a breakdown below the low on one of the world's most liquid markets. Very close to my level, just did not hit it. Yeah, we're testing this guy down here from earlier. We could see 1508 down here at the 17s, 5417s. He's currently getting tested. Why don't I short? Well, first of all, I'd be shorting a low of daybreak on a pretty much balanced session, which is not good to do. You want to be shorting the highs and buying the lows. And if I were to short down here, my stop loss would be about 10 points away. Way too wide of a stop loss. It's not how I trade. Okay, let's see what people are saying. Why am I not going long here? I'm not going long yet because I don't see any signs of buying here. You know, I'm looking for my setup. I don't see my setup at the moment. How do you know when you're over trading? I don't believe in over trading. I think that's a false word to use. If you see your setups, take your setup. I don't believe in over trading unless you're entering and exiting based off of emotions. If you're entering and exiting based off of emotions, then you shouldn't be trading at all. But over trading, I don't believe in such a thing in the sense of if you see your setup and you take it, even if you're wrong 2 or 3 times, you're not over trading. How many points do I choose for my stops? My stops are always based off of where my analysis is incorrect. For example, if I'm long right here at the 54.22s, I would place my stop loss under the low. So my risk would be about 6 points. I'm not basing my risk off of a dollar amount. I'm not basing my risk off of a percent amount. I'm basing my risk off of where my analysis is incorrect. I try to get my entry as close as possible to my stop loss because that's how I'm able to get solid risk to reward ratios. What am I seeing on Bookmap? I'm not really seeing much. We're at the bottom of the range. Shorting this is not high probability. And every time the market has tried to move up, it's failed. So longing it is also not a great location to do so. Unless we start seeing some heavy volume pouring in. You shorted the high, fail, and you made $430. Thank you. Awesome, World News. Awesome trade. Max points for my stop loss. It all depends. Like if I'm risking 10 points, I would lower my position size. If I'm risking 4 points, I would have a okay position size. If I'm risking 1 point, I would size up significantly. One thing I do want to say is FOMC usually makes and forms great trading setups. This high of day look above and fail is a very bearish indication. So moving forward, if the market opens below these 17s to 15s tomorrow and doesn't go near these high of days, this is a very short-term bearish setup forming here when the market peaks its head above and fails. We've seen many highs form because of this in the short term, and we've seen many intraday highs also form because of this in the short term. So this is something to keep an eye on that develops here. This is not a very bullish indication at all, especially with FOMC today. So that's just something to keep an eye on moving forward. This is not a healthy sign to be a bull at these prices at the highs here. I'm talking short term, not short term, medium to longer term, rest of the week, early next week. I'm not seeing a setup right now. People are saying, why am I not taking it long? Number one, it didn't hit my level. And number two, I'm not seeing my setup. Should I force a trade because I'm live streaming? Should I sit here and enter a trade just because I'm live on YouTube? No. I'm trading to make money. Let's rephrase that. I'm trading to trade my setups because my setups are what's going to make me money. I'm not going to trade here because I'm not seeing a setup and just because I want to amuse some people on the YouTube live stream, I'm going to open up a random trade. It's not going to happen. Unlike the half of the streamers that you guys probably listen to that are trading demo funds on a prop firm that are just trading to pop out affiliate links and to pop out that makes it look like they're doing something. Yeah, I mean, we missed it by a few ticks. I'm not getting in just because it missed it by a few ticks. I don't know. I'm getting this question a lot. What's my average stop loss in terms of points? It depends on the setup. It depends on the risk. It depends on the conditions. If I'm trading in a volatile condition and the market's moved off of my entry and I have to risk 8 points, 10 points on the S&P, I would just simply reduce my position size. But my risk always is based off of where I am wrong on that thesis. It could be 1 point. It could be 5 points. It could be 10 points. It's where I'm wrong on the thesis. Let's say I had a long-term outlook right now and I'm bullish on the market, which I'm not at all at these prices. And I'm long here at the 54.28s and my stop is under the 54.17s. I'd be okay risking 11 points if my target is a minimum 22, 33, 44 points above me. So it really depends on the setup, and looking for exact definitive answers in the market is something that you're always going to struggle because you're going to be in search of something that's not out there. A lot of people are searching for things that are non-existent. Setup criteria: number 1, level of interest; number 2, buyer and seller interest at that level of interest; number 3, risk makes sense; number 4, opportunity; and number 5, follow the plan. 5 steps. The market has held that negative 1,000 lot delta at the open. If I were to pull up the profile here, you can see minus 1508 here at the 17s. The market dropped down into these 17s perfectly, and it held very well. In fact, it got even thicker there, the delta. So maybe this is a buyer here. This is why the 17s to about 17s and 15s is going to be very important moving forward here. The 17s to 15s moving forward is going to be very significant in relation to the selling activity that we saw here at the high. We saw very responsive activity as the market broke above the high. So now our job, especially in contextually for the next few sessions, is gauging how well the market sells off. If the market sells off aggressively, especially below the 17s and 15s, then I would place a very large bet that these sellers here at the high are very significant and very heavy that could cause some continuation moving forward. Now, if the market fails to break these 17s like we're seeing right now, and maybe tomorrow we hold it as support, we hold that general level, then I would indicate that these sellers are not very strong, and if the market moves against them, could be really screwed and trapped, and that's when we could see more pressure to the upside. So it's all about putting the pieces to the puzzle together. Like I said, trade when you see your setups. Don't trade just because you see the market moving like a lot of people do. The green zone is just simply but from a lack of activity off the CPI data at the 8:30 news release. It's simply just lack of activity of zero volume transacted there. The market usually gravitates towards that, and we saw that perfectly right here, and it held. Hindsight was a great long, but my level was about a point lower than that, which was conservative. Joe, you asked how can I show the level? I did earlier in the stream, Joe. After this, it'll be available for replay. If you want to go back and look at it, that would be sick. It's just a lack of activity in the overnight session. You know, and everybody could talk in hindsight. Oh, you should have took it short at the high. Or, oh, you should have took it long at the low. You know? It's easy to see it in hindsight. A lot of people are hindsight traders. Yeah, we got about 4 minutes to the close. Back to the middle of the range. So I think this close is going to be significant in terms of validating how strong those sellers are at the high versus what we're going to see happen tomorrow, especially before the news that gets released tomorrow. Remember, trade when you see an opportunity or trade when you see your setups. Don't trade because you see it moving up or down. I keep repeating that, but it's so true. I see so many people in the chat saying, "Oh, I'm long in this. It's moving up," or "I'm short in this because it's moving down." Just trade when you see your setups. That's it. Yeah, I mean, the real zone was 54.16. You know, I marked the 15s as a whole even number. As a, not an even number, but increment of 5. But the real level, you know, I could go back and adjust this and say, oh, it bounced there perfectly. But I was really watching the 54.15s. And again, the level came from overnight session, CPI data. Right? Complete lack of activity. 0 trades getting facilitated here at 53.16.75. See how there's volume traded here, 54.17, directly under that, 54.16.75. 0 volume. If I were to mark 56.17 or 54.17.75, right? 54.16.75 buys, right? There's 0 volumes transacted there. That usually acts as a level of support. I mean, the market bounced off of that perfectly. You know, so that really should have been the true level today, not the 15s. And that would have worked beautifully. You know, that would have worked very well. 20-point rally off of that in 10 minutes. But, all right, I think that's going to be all for me. Market's about to close in 2 minutes. Didn't really see any setups, but that's all I got. I will catch you all in the Discord tomorrow. Peace.